Hello again, and welcome to the June 2020 video for the HR Europe Market Neutral Fund, run by myself, Paul Marriage, and Fred Batua at Tellworth Investments. It doesn't get any easier running money in 2020, does it? This was another month of enormous market rotation. I think some of the biggest actual rotations than we've seen before. We talked about rotation last month, but this month was extreme again. So navigating rotation has become a real challenge. And I think it's something we're learning fast at Tellworth to do, and I think we've done a pretty good job again this month with another small positive result. It's all about having a balanced book. Balanced books are nothing new to us at Tellworth. We've never really been factor style investors. And our long only and long short funds in the UK have always had a balance between what we call P3M stocks, which are generally long-term market leading winners. In many ways you describe these as growth stocks in the traditional fashion. And then value opportunities, which by definition are value stocks, usually unloved companies where the management teams have got levers to pull, not usually disastrous situations, but situations where the company's probably fallen out of love with the stock market for some reason. So we've really had to pull all that knowledge of growth and value out of the locker this month to deliver positive returns. And I think it's been good for Fred and me to really understand this in a European context. So what's worked well for us? Schneider has been good this month, the French electrical engineer. Schneider is nowhere near as expensive as some other high-quality industrial plays in Europe, such as Assa Abloy or Spirax Sarco. But it has many of the same attributes. It's growing strongly. It's exposed to some really attractive markets, such as energy efficiency and the expansion of data centres. Clearly, data centres are only going one way these days. That's been a really good addition, growing nicely. It's very strong EPS acceleration and on a modest multiple. On the more value angle, another place that's been important to have exposure again this month, Arkema continues to deliver. The market was positively surprised by the proposed price for the plexiglass disposal. And we think that if that goes through, there could be more disposals. Remember, there's an activist calling some of the shots here, which is helping us all, in terms of the share price at least. The management probably aren't so keen. In other parts of the market, we've been looking for more traditional value. The banks look cheap. It's not been a bad month for the banks. And you could argue that BNP is possibly one of the cheapest banks for quality in Europe. Investment bankers have been doing well as well. As you can imagine, with all the refinancing, it's not a bad time to be an investment banker again. And BNP are doing well in their investment banking business as well. So BNP, good quality bank with a value balance sheet. And we believe that it's got a lot more upside from here. The short book's been an interesting mix. Generally, it's been value stuff again there, which has been weaker for us, I think. Fraport, really weak balance sheet, and clearly the whole travel gap is big. I think people are only coming to terms with the impact of reduced travel across Europe and the globe now. You know, restaurants and cafes in airports always had a premium valuation because of the high footfall. They've gone completely the other way. So something like an airport operator is in a bad place. Fraport's got a weak balance sheet. And even though it's a popular short, and we need to be very conscious of popular shorts because they can go against you very quickly, it's delivered again this month. In the UK, Trainline is the online booking app for tickets. People sort of thought it was potentially a COVID winner as people went to ticketless, but fundamentally, 95% of revenues have gone away. No one's travelling. And if you do try and book a ticket, it's a pretty painful process, actually. There's a lot of warnings suggesting you don't really need to travel. So I think it's pretty tough for Trainline. And there's a new regulatory review coming out. At the moment, they skim 5% of the ticket price. And with governments across the world renationalising railways in COVID, including in the UK, I suspect they might be under pressure with that high commission rate. So that's been hard work. Good for us because we're short. If we look further into the rest of the portfolio, what else have we been doing? We've sold a few things where we've got nervous. IHG, we think the US recovery for that international hotel group is going to be longer, more arduous, more loss-making than perhaps the market expects. So we've sold our IHG. We've covered our excellent short in Swiss watch groups, Richemont and Swatch. We think we can probably move on from these two. There's some evidence, particularly coming out of China, that has as we're getting unlocked, that the middle market is picking up, and gifting and luxury is probably not such a bad place to be going forward. So they've been good shorts that we've moved on from. On the long side, we've added Akzo, the paint maker. So, good exposure to the kind of deco recovery. It's been good. DIY and merchants have been good. Akzo has its own self-help story with strong margin growth potential. So, adding across to the portfolio, moving it on, being active is what you've got to be in when markets, but trying not to chase the market. It's very easy to chase a growth then value type market where your portfolio never seems to work from day to day. Try and move away from that chasing the market and try and get slightly ahead of the market. Very difficult thing to do, but I think with the balance, we're achieving that a little bit more in this portfolio week in, week out. So what's the outlook? Well, this is all about how governments can really stimulate economies to unlock. Governments did a really varied job of locking economies. Some countries, I think, did pretty well with the way they went in and protected people. I think Germany is generally perceived to have done pretty well. Maybe France hasn't managed it too badly so far. The UK managed it poorly, I think, in most people's expectations. But how are governments going to manage unlock to really get economies growing? And I think that's the big risk factor. We're going to start to see companies reporting now from the unlocking phase, the first months, weeks and a month or two of sales. And we're going to see whether we're in V or U shape. All the chat we've had all year ever since COVID started is how quick the recovery will be. So that's going to be a challenging time for the fund as we see how companies are coming out versus expectations. And some expectations are pretty high out there, I think, for a speedy recovery. So I think that's going to give us some opportunities. We've seen certain sectors seem to be coming out better than people thought, like autos, for example. We added Peugeot actually earlier in the month because we think Peugeot is probably a winner there. Strong EV offer, and we've got the Fiat potential merger, lots of synergies. So it's those kind of dynamic things we need to keep doing as we come through into summer. And there's always a little bit of a sell in May, go away thing at this time of year. So I think we need to be conscious that markets could be pretty stodgy from here. We had a strong recovery broadly post the bottom of COVID, and I think we might have more choppy, more stable markets where there's a bit less direction in the next couple of months. That wouldn't surprise me. I'd be pretty relaxed with that, I think. I think that's the sort of environment this fund can thrive in as well. More challenges ahead. 2020 is not going to get any easier. I hope you all have a great summer and we can get through this together in the strategy, making money, but also staying fit and healthy ourselves. So have a good summer and we'll keep working for you to keep delivering the steady recovery and keep moving the NAV forward into the second half of 2020. Thanks for your time.